Hi, I'm Michael Ruger. I'm the managing partner at Greenbush Financial Group. Had a client ask a very good question today. They asked if they should escalate payments on their mortgage. The other question we frequently get from clients is, should I pay off my mortgage early? It's a good question because there's a lot of variables. It's not as easy as people think to just kind of say yes or no. You know, it's very common. People have like an extra $20,000 sitting in their savings account and they just say, well, I don't like debt, so I'm just going to throw this towards a mortgage so it gets paid off more quickly. The question is that really the best use of those funds and is the right and the smartest financial move? Usually some of the first questions we'll start asking is really an evaluation of the other pieces of your plan, not just how much debt you have, but what does the college savings picture look like? What does retirement look like? Do you have an emergency fund? Because we want to make sure before we just blindly start allocating cash towards your mortgage, are there other pieces of your plan that could be using help? So an example is clients have kids. We start asking questions like, do you plan to help them to pay for college? Do you have an idea of what your financial aid picture might look like? So we get an idea of how much you're going to be paying out of pocket each year. So we can then determine how much needs to be in those savings accounts by the time the kids start going to college. Do those need help from some of that $20,000 you've got in your savings account? Also, maybe retirement. What age do you plan to retire? What are your expenses going to look like in retirement? Do your retirement accounts need some help to get you to your goal as part of that $20,000? So this is kind of why we start doing this evaluation before we start applying that cash. Now, once we've really shored up that your financial plan is in good shape and we still have some extra cash left over, then it becomes a race of the interest rate on your mortgage versus what you could get in return somewhere else. So we look at most interest rate on debt as what we kind of call a risk-free rate of return. So by paying more towards a mortgage that has 4% interest, I'm actually getting a risk-free rate of return of 4%. So I've got this $20,000 sitting in my savings account, which is earning, let's say, under 1%. By taking that $20,000 and applying towards the mortgage, I'm technically getting a 4% rate of return because I'm not paying that 4% to the bank. Now, one of the biggest pushbacks that sometimes we'll get from clients is, well, Mike, my mortgage is only 4%. Why wouldn't I put that in the stock market and earn 8% per year? And my response to that is, it's not an apples to apples comparison, because when you think about it, the stock market, to get that assumed 8% rate of return, you got to take risk to get there. If I take that $20,000 and apply it towards my mortgage with 4%, I'm guaranteed to get that 4%. It's a different risk level. A mortgage interest rate would be more comparable to like a CD rate or a money market rate. And some people look at me and say, well, I can't get 4% in a CD right now. Then we would say, well, if you have extra cash, instead of it sitting in your savings account or in a CD, you might just want to apply it towards a mortgage because you're technically getting that rate of return. Now, when your mortgage, depending on your interest rate, when the mortgage interest rate is above 5%, the decision gets a little bit more simple, because if you have a mortgage rate of 6% and we can get that as a risk-free rate of return, like sometimes that can be a more weighted decision to say, yeah, you should just be applying more cash to that higher interest rate debt. Versus as soon as the interest rate on that debt on the mortgage gets below 5%, it could still be the right move, but it just takes some additional analysis to get there to decide whether or not it's the right move. The other thing you have to factor into whether you should escalate payments is how long you plan to stay in the house. So if you plan to stay in the house for a shorter duration, you want to make mortgage payments, there's less of a benefit versus someone who plans to stay in the house for 20 years. So I'll give you an example. So let's say you plan to sell your house in a year and you've got a $200,000 mortgage at 4%. If I take my extra $20,000 and I apply that towards a mortgage over that 1 year period before they sell the house, I'll save about $800 in interest, which is good. But if you compare that to someone who has that same mortgage of $200,000 and they plan to stay in the house for 20 years and it's a 20-year mortgage at 4%, if they take their $20,000 and apply it towards the mortgage, over the course of that mortgage, they're going to save a little over $9,000 in interest, which is a lot more powerful. So you can see where the duration falls into that. Now, the one wild card in this whole calculation is when you plan to retire. So as planners, usually one of our goals is we want you to have as little debt as possible on your balance sheet going into retirement. And the reason being is one of the few things that you control 100% going into retirement is how much you're going to spend. All the other things that have to factor into retirement planning, like rates of return from the market, inflation, taxes, all that other stuff, we really don't have a lot of control over, and we're making educated guesses. But your expenses, we have control over. So if you can lower your expenses by paying off the mortgage, which is usually a pretty big expense, you reduce the risk of outliving your retirement assets, which is the big plus. Now, there are two scenarios that we run into where people do carry mortgages into retirement. The one is they get to retirement, they say, listen, I've got $50,000 left on my mortgage, but all of their retirement assets are in pre-tax retirement accounts like 401ks, IRAs. So the only way they'd be able to pay off their mortgage before retirement is they took like that big disbursement of $50,000 to pay off the mortgage. Usually that doesn't make sense, because if it's coming out of a pre-tax account, you're going to pay ordinary income tax on that full disbursement in that single year, which the tax hit a lot of times will offset the fact that you paid off the mortgage. In those cases, it probably makes sense to continue to just make mortgage payments and take larger distributions from the IRA each year so it doesn't bump your tax bracket and spreads that tax hit across multiple years. It's the same for the second example, where we have clients that retire, all of their retirement assets are in a pre-tax retirement account, and they want to buy a vacation home or a second house. Instead of taking $200,000 out of an IRA in a single year and taking an enormous tax hit, usually they should probably just go take the mortgage and then just take larger distributions from their retirement accounts so they stay in those lower tax brackets and they come out in pieces. If you like this video, please hit the subscribe button so we can bring you more great financial tips. Thank you.